Hey everyone, today on the final bar, we'll wrap the week as we do every Friday. We'll look Friday close to see how this story, how this narrative has evolved. No shortage of challenges to a market thesis this week or catalyst for market movement. Overall, the market resolving higher, but the big gains were Thursday, Friday, or Wednesday and Thursday. Today on Friday, really chopped around for most of the day, finished the day flat. What does that mean for the long-term trend? What are we looking for next week? Ladies and gentlemen, this is the final bar. Hey guys, welcome to the final bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together. Focus on the message of the charts. There's so much happening right now, obviously, this week. I know as many of us have been closely following election news as it's rolled out. There's been many ups and downs, fits and starts, depending on where you're at with things. And I would say now more than ever, the message of the charts is what's most important to follow. Early in my career learning technical analysis, I was taught, someone gave me the quote, forget the news, remember the chart, which I've always thought is sort of a tongue-in-cheek thing. I mean, obviously you don't want to miss the news. You want to understand, you want to be well-informed, you want to know what's happening and what potential catalysts there are. And then a thoughtful investor thinks about how that translates into the prices, right? What are your expectations for future growth or the future evolution of trends? But the wisdom there is to not worry about the news flow as the story. The story is the chart. The charts reflects how everyone, all the composite investor, all of us putting our assets together, our minds together, what we are deciding about the future expectations. And that's where you want to focus your analysis. We have some great guests coming up next week. I was really excited about some of the conversations this week. Frank Capillari on Wednesday was really cool, talking about the breadth picture, and then another breadth conversation yesterday with Mark Ungeweir. I thought that was a really interesting sort of long-term bullish thesis he shared. Next week on Tuesday, we have Brian Shannon from Alpha Trends joining the show. On Thursday, Craig Johnson, the technical analyst at Piper Sandler in Minneapolis. And then coming up the week after, on the 17th, we have Jesse Felder coming back on the show. So really excited about those guests. And just as a preview, we're working feverishly on preparing for year end. And on StockCharts TV, we love to do some retrospective looks back at the year, focusing on the message of the charts and how that's evolved. And there's no shortage of themes to be breaking down this year, but you're going to find we have some really cool special programming focusing on the year-end activities, how you look back at your year performance-wise, how you take stock of what you've done, and start to plan ahead for what you're going to do next year. So some really great guests. Really excited to share with you very soon. We want to continue on with our Wrap the Week segment. I did want to start with a poll on our StockCharts TV page. We always have a poll running, and I encourage you to take some time to answer the question on there anytime you can. Also on our YouTube channel and on Twitter, we put out a regular poll. Recently, we asked you this week, which of these ETFs do you think performs best through year-end 2020? Gave you three choices: U.S. stocks, global developed stocks, global emerging stocks. And the votes are in. 78% saying U.S. stocks, so the SPY, 3%, the smallest number, saying EFA, which is global developed markets, and then 18% of you saying emerging markets, EEM. You know, it's an interesting one. We're going to talk about some of these different stories here as we get to our Wrap the Week segment. But pretty impressed with the breakout in EM, which is why I was interested how many would respond that way in the survey. About 20%, 18% of you, which again the overwhelming majority said U.S. stocks, and that's a decent bet based on the trends. What's interesting though is what we've seen recently in the last couple of weeks. You've seen a rotation lower in the dollar. You've seen EM breaking out to the upside. Out of EM, EFA, and SPY, which of those three? Only one of them has broken to a new 52-week high. It's EM. It's the chart we're looking at. So, it's interesting that as that theme evolves, what's interesting to me based on that poll is I think a lot of people are not thinking about non-U.S. stocks as being an area of focus, but I would be focused on the trends. And you see it emerge in a place like EM, I would pay attention to it. Let's continue our wrap the week segment. Let's look at this weekly wrap chart. I'm going to refresh it just to get through the close. This is how the week ended up. The S&P is right here. This is taking the percent return from last Friday's close. The S&P finished up this week about 7.25%, and these might fluctuate just a bit as we're processing the closing prices, but that's about right for where we're going to end up here. Sort of chopped around here. These all got jumbled around here at the last second, but emerging markets, small caps, and the S&P all within that margin of error right around the S&P, so about 7 to 7.25%. Only two assets really outperformed the U.S. market or U.S. stocks. The NASDAQ was up over 9%. The real winner was Bitcoin, up almost 14%. Most of those gains came yesterday with a huge gap higher, a huge move higher in Bitcoin prices. Pretty much, and cryptocurrencies across the board, but Bitcoin is the one we're following here, up the most out of these asset classes. What underperformed? Crude oil actually had been hanging in okay and started the week pretty strong, but sold off the last couple of days to be up about 4.8%. Gold only up about 4%. Bond prices actually still higher. So we talked about that stock bond ratio clearly has been favoring stocks, but both assets actually were up this week as yields came off a bit. So bonds up 1.25%. So only one out of this basket underperformed. That's the dollar, down 1.9%. Let's look very quickly to some of these asset classes and think about the charts here. This is the U.S. dollar chart. This isn't updated for today's close. This is through Thursday's close, but it came off a little bit, so it's going to be a little bit further down around the 92.30-ish level. I want to say. Well, we'll see where the closing price comes in. But we talked about this and right about here as it broke above trendline resistance, as it broke above a new swing high. I've talked about most likely dollars going to continue higher. Retest this 96.40 to 96.50 level. That's the 200-day. That's the first Fibonacci resistance. That's also this bear flag pattern that we had back from June. Seemed like a very reasonable thesis. I have to say at this point, that's pretty much broken, and I'll declare a loss on that one because the lower high that we've seen here on the dollar index right below 94.50 sort of confirms a transition to this lower trend, and now we're testing the very all-time low. So again, this could end up being a broad bottoming pattern before we revert higher, but the upside is not happening right at this moment. This is weaker rather than stronger. And speaking to the weakness in the dollar relative to other currencies, and in general, when you think about the dollar and the value of it, it's not always just in a vacuum, right? So the dollar does one thing, that doesn't mean all these other things are going to happen, but there's a traditional relationship, right? A stronger dollar tends to be stronger for U.S. stocks, and especially for small caps. The weaker dollar environment you see here should be favoring some non-U.S. markets, and you see the breakout in EM, not so much in IFA, but certainly with emerging markets. So certainly a theme to be paying attention to as we go forward. Gold sort of chopped around here, but it started to resolve to the upside. I wanted to highlight here because it's broken above its swing high. We've talked about the sideways trend in gold. We talked about it, trading between these two Fibonacci levels. We've talked about its inability to break above Fibonacci resistance. That all changed on Thursday. Sort of everything was in a rally yesterday. Bit of a follow through just a little bit today, but overall we're back above that key resistance level that we've not been able to be above. So overall, I think this opens the door to gold continuing further. As we've talked about, I still see long-term upside to the previous highs, if not further. And I think this may have been the beginning of that uptrend. So worth paying attention to the GLD and gold stocks for sure if you've not been paying attention to it as much. We talked about bonds. This is the TLT, so it's sort of chopping around here. So it's just like gold has rotated higher, bond prices have not. So up today a little bit, depending on what you looked at, but overall still sort of chopping around this general area. And again, I think being able to get back above the 50-day moving average would be the first step for the TLT, sort of resuming an uptrend. At this point, it continues to be a pattern of lower highs and lower lows, and that's not what uptrends are made of. That's a downtrend. The other thing to do is pay attention to the trend line connecting these previous highs. We traded just above it, but still not able to follow through above, and I think that's one of the charts to be paying attention to. Just very quickly, as I mentioned today, the S&P chopping around, not really finishing meaningfully one way or the other. If there was a story for today from the equity side, I would say it's small caps underperforming. Small caps down 1%. As we get to our Mindful Investor Live chart list, we'll focus on that cumulative advanced decline lines. This is not going to help the small cap or mid cap trends, and the small cap trend in particular is one that we've been talking about. The absence of confirmation from small caps, I think, is one key missing part of the bullish thesis here. Bond prices, I mentioned, down just over 1%, yields a little bit up, but overall for the week finished weaker. The dollar a little weaker as well. Gold and silver up a little bit, just a token amount, and cryptocurrencies essentially up except for Bitcoin today, which was down a little bit. But overall, you've seen some strong moves and strong upside with a lot of these over the course of the week. The sector picture was pretty mixed today, and it's an interesting way to finish the week. Every day of this week has had an interesting message. Tuesday, it was the expectation leading into election day, election night into the morning, overnight Eastern time was where you saw a lot of movement in the overnight futures. But then Wednesday was about a rally on limited participation, limited breadth. Yesterday was an upside move with very much confirmation, all 85% of stocks moving higher. Today was sort of a flat day, sort of a mixed bag. You had consumer staples, technology, materials, 1, 2, 3 up. You had energy, financials, real estate at the bottom. About half the sectors higher, half the sectors lower. This is the definition of what I would call a digestion day, right? A big move, you have a digestion. You've eaten the big meal. You now need time for it to settle in your stomach before you sort of get to your next activity. And so, a perfect way to end this this crazy week, this sort of volatile week in terms of expectations and how fluid they've been. It'll be interesting, obviously, as we continue to process news on the elections today versus where we're at Monday. It might be in a very different place in terms of having some sense of closure to what might be next at the in the executive branch and elsewhere. So that could lead the way for next week and what to expect there. The rest of our time, we're going to spend in the Mindful Investor live chart list. If you've never looked at this one before and you want to get access to it, it's through StockCharts.com. Click on articles. Up here in the upper right, go to my blog, which is called The Mindful Investor, and you'll see this link for a live chart list that'll take us to this page. You're welcome to follow along, save them to your own login, do whatever you want with them. Chart number 1 is the long-term market trend. It's actually pretty interesting because the long-term trend has been positive. It hasn't changed. That's about right. And we're this close to all-time highs, even on the pullbacks. That's about right. It's interesting, a little below there. So the short-term signal actually turned positive in the last couple of days. This is looking at the week where we're at right now versus the 5-week exponential moving average. It was negative the last couple of weeks, actually back to positive as of Friday's close. So overall, suggesting the short-term trend positive coming off of that swing into the strength this week. The medium-term trend, it looks like finishing the week still negative. It turned negative last Friday and remaining negative this Friday. Pretty close to turning positive. It didn't get quite enough of a rally to trigger it. If we continue to remain about these levels, most likely that would turn positive next Friday, and we would have positive across the board. If we would come off a little bit, that will most likely remain negative and kind of go from there. So that's about right, given where we're at. I think we were, right at that tipping point where the medium-term sort of weekly model would turn positive. Didn't quite do it. The daily chart, as we've talked about for a while, I think this range of 3,200 to 3,600 is really the range, and I don't feel super optimistic about dramatically higher highs beyond 3,600. Just like I don't feel super optimistic about dramatically lower lows below 3,200. It seems like this range continues to be the range, and again, I will absolutely tell you the moment that we break out on better breadth. I will tell you when we break down with some sort of increased negativity. But at this point, it still feels very range bound. We literally, if you take a step back to look at the 30,000 foot view of this chart, we hit a peak in February, we hit a low in March, we then retraced 100% of that move. We overshot the February high a little bit and then undershot it, overshot it, undershot it, overshot it. We've literally been rotating around the 3,400 level as a midpoint to this coil pattern. So this is in some ways could be just a big double top of sorts. That would be invalidated if we break above 3,600 and confirm an upside move. That would be very validated if we break below 3,200. I think would end up being potentially a major double top pattern. Between now and then, we're range bound. I would expect that to continue. As the S&P has tried to regain its previous highs, when we look at the breadth picture, and as a qualifier, remember this is not quite updated for today's close on Friday just yet. That'll come a little later, but you can see how this plays out. I would not anticipate it moving much further to the upside given where we close, but we'll see. But you can see that the S&P advanced decline line, cumulative advanced decline line, has confirmed a break to new highs. really breaking to almost all-time highs this last couple days. The mid-cap one actually also as well, just sort of retesting almost to the penny, the all-time high there. So those two have broken above their swing highs from August. The New York Stock Exchange has not yet. The small cap index has not yet. And I would expect both of those to come out, given the small cap index was down 1%. So it's interesting. My guest on Wednesday, Frank Capillari, made a great argument for this line here, the strength in the S&P advanced decline line. And I can't argue with that. It's absolutely right. For looking at the S&P and looking at the S&P advanced decline line, it appears that it's already confirmed to break out to new highs. That shows strength. For me, though, I always look at a couple others as well, and I think the mid cap does confirm that. The small cap does not, though. And again, can the market continue to rally without small caps breaking out? Of course, it's happened before, but I feel much more confident about further upside when it's confirmed across the board, and especially if these are making higher peaks and the small cap index is not. That starts to tell me to be skeptical. Again, this one not quite updated for today. This is new highs in the S&P. Wednesday and Thursday certainly saw an acceleration of that. What's happening now is we have the same number of acceleration of new highs that we saw leading into the October peaks. This is looking very similar, a run higher to that 35, 50, 3,600 level, increasing new highs. That was the end of that move, and we're showing a similar pattern here. Further upside could be confirmed if you see the new highs continue higher and higher. And I think going into next week, that's one certain open question mark. Breadth in the form of stocks above their moving averaging remaining pretty positive, to be honest. These had sort of gone neutral to negative as only 30% of stocks are above their 50-day. That's rotated back to about 2 out of 3, so 2/3 of S&P stocks above their 50-day moving average. We're going to skip a couple of these just for the sake of time. I just wanted to finish with this one. I'm thinking of the weekly, week to week, in terms of one chart that has followed through to the upside and is certainly a check in the bullish column, is the relative strength of semiconductors. On a price basis, new 52-week highs for the SMH. On a relative basis, new 52-week highs. Overall, when that group is doing well, it tells you economic conditions aren't too bad, and the market is voting higher rather than lower. We'll stop with that. Take a quick commercial break, back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we love to hear from you. Feedback on our shows in particular and questions that you're running into. We have just opened a survey trying to gather feedback over the next couple weeks on StockCharts TV. We're doing some new programs going into the new year. We're creating some really cool new ways to consume StockCharts TV content. We're very interested in hearing from you in terms of what we could do more of, what we should do less of, and what we could do better. Would you do me a favor, go to StockCharts.com/TV. There's a link on that page to answer our survey. It should just take a couple minutes, but it's going to provide us some great feedback. We would love to hear from you and do more of what you want us to do more of, and help add value to your process. In terms of questions that you're running into, as always, we're here to answer questions on technical analysis, on charts, on particular tickers, and what you're hearing elsewhere, whatever it is, shoot it to me via email, thefinalbar@stockcharts.com. On Twitter, just tag us at FinalBarSCTV, or on our YouTube channel, just put a comment below the video that you're watching. We'll capture all of those and try to get to as many as we can on the air. Let's open the Final Bar Mailbag today. These questions have all come from you in the last 24, 48 hours. I appreciate you sending these all in. Next question, or first question, thanks for your insights and methodical approach. The show is very informative. I appreciate that. Within the last 2 to 3 weeks, you hosted someone who uses cycles for market analysis. I couldn't find the episode, but I would like to follow up. Yeah, that's Jeff Greenblatt from Lucas Wave International. That was last week, and I forget which day. It was probably Wednesday of last week, if I remember right. But if you go to our YouTube channel, look for the Stock Charts channel and search for Jeff Greenblatt, you'll see his interview on the show. He was talking about Fibonacci time cycles, which again is really outside of my normal process. And I love talking with people that focus on things I don't focus on, and not just with technical indicators, people that focus on other policy and, macroeconomic strategy and all those other things. Some of my favorite conversations over the years have been with people that are not technically oriented or use a different toolkit than I did. If you're interested in cycles, I would also make a point of checking out the presidential cycle special we did a couple weeks ago. That was with Jeff Hirsch from Stock Traders Almanac, Tom McClellan from the McClellan Market Report, and Bruce Frazier, expert in Wyckoff analysis. They did such a great job of talking about the seasonal tendencies of November and December to being very strong, how the market tends to do different given an incumbent president losing for the second term, a new Democrat coming in office. It is really, given what's happening and the uncertainty, and as things start to fall into place, I would check that out because they had some great data showing what the traditional cycles have been. Next question, this came over Twitter. So I tweeted earlier about pizza, PZZA, which is Papa John's. As usual, I have pizza on the brain. We have Keller Family Pizza Friday happening here shortly, which is always very exciting. But I tweeted about Papa John's and said, it's coming off of its moving averages. Let me bring up the chart here real quick. Basically said it's coming off of the 200-day moving average. If you draw the Fibonacci retracement, so I'm going to go here to Fibonacci, take the low from March, connect it to where we hit there. You can see we lined up right off of just below 75. So it pulled back 38.2% of the way, which is right at the 200. It was a confluence of support, sort of bounced off. It just seems like a perfect example of an opportunity to buy on the dips, a pullback. And the question was, so if you were still at Fidelity, when would you advise a portfolio manager as to when it was safe to go back into PZZA? Now we're at what level? And it's a tough question to answer, only because at a place like that, you have a lot of money managers running a lot of different processes. And I think the key to what we were able to do there was focusing on each portfolio and what would make sense for them. So I can't make a blanket statement, but I would say, just generally speaking, two things I would say. Number one, I highlighted that because I would say it's a pretty good entry point. And the reason why is this, right? In general, long-term uptrends, of which Papa John's, questionable, but certainly coming out of the March lows, pretty good uptrend, but then a buyable pullback. Buying at new highs can be very profitable, but it can also be very difficult to justify buying when, the price keeps moving higher. You feel like you've already missed out. But buying after a pullback, there's a reason why a lot of quantitative models look for a strong 1 year and a weak 1 month, because it shows stocks that have pulled back to a more opportunistic level. And what definitely reminds me of charts we would have looked at Fidelity was recommending a chart like this was very difficult because of the amount of some of those funds. If you're, trying to put, millions and millions of dollars, if you're running a $10 billion fund, you want to make a decent, size bet on a stock like this, you have to accumulate a lot of shares, and buying into highs is really tough because all you're going to do is accelerate the uptrend. Buying into this environment is much easier because it's easier to get filled. You're going to get better levels. You're not going to shock the market and accelerate things. And so certainly reminds me of the types of things we would be looking at: strong uptrends and pullbacks in the short term. So I certainly think, and what I like about a chart like that, it gives you a clear support level for any sort of stop, sort of a technical stop. Next question. I've been watching your show for many months. I'm a new subscriber to StockCharts. Welcome. It's great to have you. You often show gaps on the charts, but don't really explain their significance. Are gaps, especially more than one in the same direction, a significant sign of price thrust? Is there a difference as the stock is already overbought or oversold? And while you went through a lot of detailed questions, Arne, I can't get to all of this, but you're basically asking, what do we do around gaps? And boy, I should have had a gap example ready. I'm just going to bring up a couple charts here. So, there are many, so they're essentially, if you look back at the literature, and I would go to a couple places, I would bring up John Murphy's book, Technical Analysis of the Financial Markets. That's where I first read about gaps. And I think what he talks about is still simplistic, but very valuable. And there are three different types of gaps. There's a breakaway gap, which is something that comes off of a low price, sort of the beginning of a new uptrend. There's a continuation gap that happens sort of midway through a trend. And then there's an exhaustion gap. After something has had a really good run, you have like one big gasp higher. I don't really see an example of that on the chart. But the ways you analyze all of those are all very, very different. So general things I would tell you, more often than not, gaps can be very key support and resistance levels. I'll always talk about whether a stock has filled the gap, right? Reclaiming that price that we missed when it changed. Gaps happen on the charts coincidentally because of something that happened between 4 p.m. on that moment and 9:30 a.m. Eastern the next day, right? Something happened, an earnings release, a news flow, whatever it was, something caused investors to decide that there's a very different price level that Apple should be on from one close to the next open. And so there's something happening there. Usually we'll find it about once a quarter around earnings because of that reason. The other thing I'd point you to, and again, I'm sorry we can't get to this more. Maybe this is something we could do a special on at some point. But Julie Dahlquist, who along with Charlie Kirkpatrick, wrote one of the best textbooks on technical analysis, just called Technical Analysis, and then some sort of subtitle. She actually did some great academic research talking about gaps and how successful they are. So if you Google Julie Dahlquist, who's a professor at UT San Antonio, I want to say, but a CMT, and has done fantastic work writing for technical analysis. She did a lot of really good work on testing gaps and their success rates. I'd point you to her work. Finally, how do you use the VWAP indicator? Nothing seems to show up whenever I select it. I've tried inputting random numbers into the parameter just to see what would happen, and nothing does. I'm not 100% sure what you're talking about, but I'm guessing it's the anchored VWAP, which is the indicator that we have in ACP. If that's not what you're talking about, just shoot me an email, thefinalbar@stockcharts.com. Let me know if there's something else you're wanting to find. But it's timely you would ask about VWAP, because Brian Shannon from Alpha Trends, who designed this indicator, is coming on our show on next week on Tuesday, I believe. And so I'd certainly encourage you to check in for that one. But anchored VWAP is part of the StockCharts Advanced Indicator Toolkit. It's free. It's part of ACP. So if you go to the little plug icon down here and install the StockCharts Advanced Indicator Pack, this is one of them that you're going to get. And basically the way that the anchored VWAP works is you can manually enter a date, or you can just click on the chart. So if I click on the high, and this is using Electronic Arts, I basically started the clock there, and it's a VWAP because it's taking the volume weighted average price for every day, but it's anchored because I'm starting the clock right there, and I'm plotting how this anchored VWAP has evolved over time. So it's continuing to plot and update the average volume weighted average price, and it's accumulating those values. And more often than not, you find it serves as support and resistance, as it did here with Electronic Arts end of September, beginning of October. And as we bounced up a little bit, that was certainly a level I would have been looking for. So again, if you're interested in that sort of analysis, Brian Shannon, who designed this, is going to be on the show on Tuesday, and probably will have some good examples to share with you. Those are some great questions. Thank you all so much for writing in and sharing what you're looking at and what you need. Happy to answer your questions anytime. We need to wrap the show and wrap this week by going to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the dollar index. We've talked about the strengthening dollar and potential upside that hasn't played out. We're seeing more of a weaker dollar environment. So I think it's worth reviewing this chart and thinking about what an extended weaker dollar, if it remains in this level or even goes a little bit lower, what that could mean to small caps versus large caps, to US versus non-US, and think about how you might be positioned relative to a weaker dollar environment, and at what point would it tell you that the weaker dollar environment is over and that we're strengthening? For me now, I think it's that peak from September. That's certainly would want to get above there before you felt like there was meaningful further upside. But at this point, we're testing the lows of the range, and a weaker dollar seems to be the story for the near future. Riffing on that theme, the second chart is emerging markets, EEM. If you look at U.S. Global developed and global emerging, only one of those three has made a new 52-week high this week, and it's emerging markets. It's not either of the other two. If you look at the chart of EEM, you see the peak in January, the low in March. We returned to that. We sort of round trip there, and now this week have broken back above it. So we'd found resistance right at those highs there in October, and then here we go the first week in November when we've broken to new highs. So overall, it's in a really good place. It's a strong uptrend, and outperformance has been actually fairly impressive for the last month or two. Finally, I'll leave you with this chart, the relative strength of semiconductors. This is a group that I followed. I remember talking with Dan Russo about this a number of times, thinking about the strength in semiconductors and what that means. Think about Charles Dow and the idea of looking at industrials and railroads as measuring the strength of the economy and what companies are able to do. Arguably, semiconductors are the backbone of what we do now with everything being, electronic on demand. And so the strength of semiconductors tells you that demand is there. It tells you the prices are working, and it tells you that overall that is a check in the bullish column, not the bearish column for stocks. Folks, that is a wrap for this week and a wrap for a week on the final bar. I want to thank you so much for joining us. Please go to stockcharts.com/TV, fill out our survey. Let us know what we could do better. We'd love to hear from you. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.